Hey there, and welcome to the channel. In today's video, we are doing a case study of Nvidia, which has been the hottest stock of 2023. Now, we are obviously not going to buy into the company at the present valuation, but the market cap of the company is $1.2 trillion, and the enterprise value to free cash is 70. So it's safe to say we missed the boat on that one. But what I'm going to do instead is that I'm going to go to valueinvestorsclub.com and look at the write-ups that they have on Nvidia, which are from 2002, 2010, and 2015, and look at the financials from that time to try to see if I would have been able to pick up shares in the company, judging from the write-up and the financials. I do think it's good for us to do these case studies to try to study the winners and try to get better at pattern recognition. Now, Nvidia is truly a winner where they've gone from a market cap of $2 billion when they were written up in 2002 to the current market cap of 1.2 trillion in 21 years. And that's a compounded annual growth rate of 35%, which is really amazing. I don't know if the guy that wrote up Nvidia back in 2002 still has his shares, but there are definitely some investors that have held through the 21 years and gotten a fantastic return on their money. Now, the reason why I like to study old write-ups on Value Investors Club is because I read the website very frequently to try to get new ideas. And for example, I read this write-up on Fair Isaac or FICO back in 2021, and I went through the whole write-up and was able to understand the company. And the company checked all my boxes, except I wasn't willing to pay the price to free cash flow of 25, which in hindsight was a big mistake. That's one of those mistakes of omission that I'm probably going to make plenty more of in the future. But as you can see, FICO had a market cap of 11.5 billion when this was written up. And today, approximately 2.5 years later, the market cap is 27 billion. So a pretty decent return there. And I would have been able to get into a fantastic company at a fair price, which is FICO. But you live and you learn. So let's get into it. And like I talked about, these three write-ups are the write-ups that we're going to be looking at today, with the first one being in 2002. Now, in 2002, the company had a market cap of 2 billion, but they had just IPO'd back in 99, and they still had negative free cash flow. So I would say Nvidia back in December of 2002, when this was written up, was uninvestable for me personally. Let's move on to the next write-up from August of 2010, where the market cap of Nvidia was 5.6 billion, and the company had not been doing well on the market due to a couple of factors. The first one, that Nvidia had lost a ton of market share, about 8%, to their competitors, where Intel and AMD were capturing more and more of the market with their integrated and embedded solutions, and also with the GPU business being very cyclical. And finally, Nvidia had a lawsuit with Intel, which is never good news for investors. And also, the author of this write-up was warning investors that the company is a stock option abuser and to beware of dilution, which is never good to see in a stock that you want to invest in. And if we go to the cash flow statement, we would be looking at some kind of mixture of the 2009 and 2010 numbers. And if we scroll down to the bottom, we can see that in 2009, free cash flow was actually negative, but had begun to recover to about 410 million at the end of 2010. But that was down from a high of over $1 billion in 2008 and $440 million in 2007. So back in 2010, I think it's safe to say that for me personally, I would not have been able to pick up shares in the company. Now let's look at the 2015 write-up from July of that year, where the market cap was now 10.6 billion. This is about 5 years since the last write-up, which means that investors that invested based on the write-up back in 2010 had doubled their money and gotten a return of about 15% per year, which is not too bad. So the author of this write-up points out the bear case for Nvidia, which is their GPU technology, which is mostly found in PCs. And at this point back in 2015, PCs were in a terminal decline. And he talks about here the company being a mess with the core GPU business getting eaten alive by declining PC sales and the company not being able to enter the mobile market. And they are also fighting IP battles and trying to compete against some of the largest, best capitalized technology companies on the planet, including Intel, AMD, and Qualcomm. But at this point in the company's history, the business mix was changing a lot, and the company was relying more on the gaming revenue, especially in the mobile section, which back in 2015 were growing really fast. By this time, Nvidia had also positioned itself as the dominant PC gaming platform with their GeForce GPUs. So I would say there were a lot of positives for the company, and if we look at their financials, we can see a decent growth in their revenue, along with good growth in their gross profits. And since this was written up in July of 2015, we would be looking at a mixture of these two numbers here. And this is, of course, a cyclical company, so you have to take that into account when looking at the financials. And compared to a market cap of 10 billion, the company had 4.6 billion of cash on the balance sheet, which is pretty good. And if you look at the liability side, the company had no short-term debt and only 1.3 billion in long-term debt. And the company had been notorious for diluting their shareholders. So if we take a look at the shares outstanding, we can actually see the shares going down year by year, which is a big positive for the company. Now, the free cash flow is nothing to be that happy about, at about 700 million in the middle of 2015 from a high of over $1 billion in 2008. So at this point in time, you would probably be asking yourself if the company would be able to return to a free cash flow of over $1 billion, which is definitely a hard question to answer. So we can see the return on equity, which is not that high for the company at around 13 or 16 in 2015 from a high of 49% in 2008. And you can see the same pattern with the return on invested capital, which is 32% in 2008 and had gone down to 8% in 2014. The gross margins, however, are the highest that they've ever been for the company back in 2015. And the operating margin is getting better, but is still not as high as it was back in 2008. Now, if we look towards the price to free cash flow back in 2015, this starts to get exciting. We can see that the average was 10, with the price to free cash flow low of 2015 being 8, which means that the company was trading at a free cash flow yield of about 9 to 11%. And if you would have been able to pick up shares of Nvidia at a free cash flow yield of 10%, you wouldn't have needed much growth to get a good return on your money. And if we summarize the investment thesis in a couple of sentences, I think the company has a pretty understandable business model, but I would have to put a question mark on the competitive advantage. At this point back in 2015, it would have been pretty hard to see which company was the dominant player in the market. The management team of the company has quite a lot of skin in the game, but they have really subpar capital allocation skills. But I guess with a cyclical company like Nvidia, it's pretty hard to maintain a high return on capital. And finally, the company is trading at a very attractive valuation, especially if you could have picked up shares at a free cash flow yield of 11%. And if you look at the history for the price to free cash flow for Nvidia, we can see that the company took a jump in 2017 up to 42. And if I would have picked up shares back in 2010 at a price to free cash flow of about 10, since I would be judging the investment as a fair company at a wonderful price, since they are a very cyclical company and have a lot of competitive risks, along with their subpar capital allocation. But buying a company at a 10% free cash flow yield that has very little debt and a lot of cash on the balance sheet could be a pretty sound strategy to get good returns in a short time. Where if we look at the market cap back in 2017, it was up to 63 billion by the end of the year. So you would have gotten pretty decent return on your money, but I would have definitely not held on to the stock, which definitely would have been a big mistake. But that's easy for us to say now when we have all of the financials in front of us and hindsight bias working against us. But I won't be making this video any longer today. I do want to ask you to like and subscribe to the channel if you get any value out of the content that I'm providing. I want to thank you for watching, and I will catch you on the next one.